Thanks. So when Peter invited me to the conference give a panel discussion on, the intersection of finance and accounting and cross-border research, I said, that sounds great. I can just talk about my work and won't have to worry about it, discuss it. And then after agreeing, I went back and read the conference program again. It said a criticism of cross-border research, and I said, well, I don't want to criticize my new research, so what do I do? Well, maybe I'll criticize other people's research. But when I started thinking about that, then half of the people in the audience when I saw the list of participants. So I kind of went back to the drawing board and said, what I'll do is kind of go back and take a critical look at sort of the entire sort of research. I've been spending a lot of time in the last sort of decade on cross listings, and then maybe sneak in some of the new stuff that I'm doing to kind of maybe suggest a new avenue and some new results of what we've learned. So I think it's going to fit nicely what Craig was talking about. So this is something I dug up when I was looking at old files of mine from when I was defending my dissertation. So this is a graph of cross listings in the US in up till 1995. And so we saw this huge increase in the number of listings in the US, and there were lots of theoretical models. Mostly at that point it was sort of international asset pricing models under barriers to segmentation that said firms should see reductions in their cost of capital when they globalize. But up till then there really hadn't been any empirical research that had shown any real benefits to cross listings. So there were a lot of studies, and basically the results were extremely mixed. And so I wrote a paper called Why Do Foreign Firms List in the US? Okay, and basically showed that there was if you measure it correctly, you can find this large positive stock price reaction when firms announce a listing in the US. Okay, and so I said I had solved the question, right? I answered why they list in the US. Well, the journal editor said, no, you didn't. So they made me change the name of the paper to not Why Do Foreign Firms List in the US, but to The Market Reaction to International Cross Listings. So I took that as a challenge over the next 10 years to try to figure out, why do foreign firms list in the US? And obviously a lot of other people have looked at this question as well. Okay? So from that past to the present, we've seen sort of a general shift from sort of these rationales from listings for looking at, these sort of cost of capital arguments in terms of barriers or segmentations of legal rules to really much this idea that Craig was alluding to about the governance implications of listings and the disclosure implications of listings. So really what we're looking at the present, I think, are two main questions that sort of are in the literature. And the first is, does sort of one country's security laws reach the firms that are in that country from a foreign country? So is it possible for a company to opt in to better securities laws by listing into another country's legal system? And this is sort of talked about over the last day or two, formalized as the bonding hypothesis that Coffey and Stultz first came up with. And a lot of times we motivate this and analyze this using the highest legal regime, that is the US market. And the second sort of debate now that Craig alluded to, that he's right in the middle of, he didn't sort of give you the good juicy details of the controversy of sort of the idea, has the US market become uncompetitive and have we over-regulated? So the idea, are the sort of cost of US regulations exceeding the benefits? And this is getting all this attention between sort of the rise of London listings and the sort of the decrease in the numbers of firms choosing to raise capital in the US. And so the question I want to focus on is, why is there a debate right now? Why do we see so much controversy? How come the answer is not clear in those questions, right? Why are there two sides to this? So let's look at these both in turn. So the first, I won't go into this in detail since it's been brought up in a number of papers, but at the essence of this bonding hypothesis, people want to know, is it possible for US securities laws to reach foreign firms, right? Do they have a measurable effect on the governance or the disclosure practices of those firms, okay? And this is, the broader question is this idea of the functional convergence of global legal systems. Craig talked about, there's a lot of research that suggests that good corporate governance is associated with higher firm value, larger GDP growth, all these good benefits, and obviously getting, say, China to change their whole legal system is a very difficult thing to do, right? So the legal convergence of global corporate governance is very difficult. So there's a lot of interest in whether or not firms can actually do it in a market-based approach. Can we say cross-list and actually improve our corporate governance and have big economic impacts, okay? And so when looking at sort of this idea of functional convergence, I think it's very important to pin down exactly what this theory of bonding says and what it doesn't say. What the bonding hypothesis says is that firms that cross-list in a better legal regime will have better corporate governance. That is, they will protect minority shareholders better, okay? And this effect will be largest for the more stringent of a legal regime they go into, okay? And it'll help the most for the firms that are located in countries that have the weakest home country legal regime, okay? What it doesn't predict explicitly is economic outcomes, okay? It doesn't predict stock price reaction. It doesn't predict these second order effects, okay? And so the question is whether or not bonding holds. In my opinion, the reason why it's in such a debate is because almost all the evidence is sort of transformed from these economic predictions of cross-listing research. And so, there's been early work by myself and Forrest and Crowley that showed that they have these positive stock price reactions around listings, higher valuations for these cross-listed firms, more scrutiny by financial analysts. Steve was talking about it yesterday. I have a series of papers with Mark Lang and Carl Linz. All the information that talks about better information environments. Ellie has one of the first papers that actually looks at this, the value relevance of 20F forms, and do firms that sort of now do U.S. types of disclosures, are their information environments better, okay? Firms that cross-list in the U.S. and go to these higher standards seem to have lower cost of capital, okay? They seem to have better access to external finance, and they tend to have lower voting premiums, so these control premiums are lower. So all these economic sort of indicators suggest evidence that's consistent with the bonding hypothesis, okay? But the problem is that all these theories of cross-listing, not just the bonding hypothesis, all predict directions of the same magnitude as the bonding hypothesis. So let me give you an example. To beat up one study, I'll pick my own, okay? So this is a table from my paper that showed positive stock price reaction. Where does the firms gain the most when they announce a cross-listing in the U.S.? Well, they have the most positive stock price reaction for firms that list on the New York Stock Exchange, largest positive, right? And you see virtually no reaction for those that go in the over-the-counter market, and a much lower reaction for those on level 1 listings. So what do we see? If you read John Coffey's paper, he says this is consistent with the bonding hypothesis, right? Because firms opting into the best legal regimes have the highest stock price reaction. Moreover, it's consistent with the bonding hypothesis because firms from emerging markets have much higher reactions than firms from developed markets, okay? And so very consistent with the bonding hypothesis. The problem is, if you go back and read my paper, I motivated the bonding hypothesis wasn't around. So it was completely consistent with all the international asset pricing models under barriers to segmentation, right? It's also consistent with the liquidity story, right? So more liquidity in the New York Stock Exchange and less liquidity in emerging markets. It's also consistent with the Merton 87 study of investor recognition. You would expect more investor recognition on these larger stock exchanges and from firms with emerging markets. So it really gets back to the idea of trying to distinguish amongst all these theories of cross-listings is phenomenally difficult, right? They almost all predict economic sort of outcomes in the same direction. So in my opinion, that's sort of why we're sort of having a difficult time sort of nailing down which is the rationale here and does bonding really hold, because we have all these competing theories that are very difficult to distinguish. Now on the other side, there's evidence that suggests bonding doesn't work. Okay, and in my opinion, those studies are no less problematic. And so, Jordan Siegel has a really neat paper that suggests that, Mexican firms stole all kind of assets during the Mexican peso crisis. Many of these were cross-listed, and the SEC never prosecuted. So the arm of the U.S. regulatory environment didn't really reach out to them. But then you go back and read the legal scholars, and they say, well, the incidence of prosecution doesn't tell you how much was deterred. So there's all these sorts of caveats to even those results. Wendy has a paper that shows that cross-listed firms, although they go into the U.S. accounting system, they actually don't have earnings of comparable quality to U.S. firms. So there seems to be limits there as well. Greg's paper that basically showing that firms adopting GAAP don't always adopt it as they should. So again, there's sort of mixed evidence on the other side that people argue that may not be conclusive evidence actually against the bonding hypothesis as well. And third thing that makes it very difficult to test the bonding hypothesis is because, say we want to go look at a mechanism of governance. Say, do you look at, say, the boards of directors? Do you look at ownership structure? Well, looking at a mechanism of governance doesn't necessarily tell you an outcome of governance, right? The bonding hypothesis is telling you that basically we're going to expect firms that have better corporate governance than non-cross-listed firms, but just because you see, say, more dispersed ownership doesn't necessarily mean that is a better governed firm, given all these types of mechanisms can substitute or be complements for each other's. And in the cross-listing research is even more problematic because we see, during cross-listing there are all these different types of changes. For example, analyst following, as Steve showed yesterday, analyst following is changing. They may have a governance role, and so that could either substitute or complements other things that are going on at the same time. Okay? So I think it's very, very difficult to sort of ascribe a lot of this evidence and come up with definite conclusions. Okay? So how can I weave in my own research now? So a sort of a new approach that I think is going to give some traction is looking at governance outcomes. And so what we argue in a new paper is that if you want to really test the bonding hypothesis, what you have to do is test the central prediction, that is looking at outcomes of governance. And what do we choose here? We choose CEO turnover. Do you fire a poorly performing CEO? Okay? And so we basically motivate this on a long line of research that basically suggests that a necessary component of corporate governance is to fire a poorly performing CEO. And that's been sort of verified in a long series of papers in the US. And there's actually some papers, DeFawn and Hung have a nice paper in the jar that looks at this as well internationally in relating sort of corporate governance regimes to how they sort of terminate poorly performing CEOs. Okay. So what do? We look at 70,000 firm year observations from 42 different countries and basically try to ask those specific questions of the bonding hypothesis. Do cross-listed firms have better corporate governance than non-cross-listed firms in terms of outcomes? Are the U.S. listings associated with the strongest predictions affect governance the most? And does this matter the most for firms that are located in weak countries? And just to kind of throw a table up there, this morning I was looking at my presentation, I had no tables, and I figured I couldn't do that, so I had to throw in some tables there. But basically, at the end of the day, what do we find? If you look at the interaction for the level 2, 3 ADRs and various performance measures, it's negative. So what you find is that cross-listed firms are more likely to have CEO turnover when performance is poor. Okay, so this is very consistent, we argue, with the central predictions of the bonding hypothesis. And where does it show up? It shows up in civil law, low disclosure, low anti-director rights, the variety of all these different measures. It matters most when sort of the investors are protected least in their home country. Okay, and so if you just look at sort of the economic significance, it's similar to or a little bit higher than what we find in U.S. CEO performance sensitivity turnovers. Okay, and so we argue in this paper that this provides perhaps some more direct support for the major tenets of the bonding hypothesis and actually suggests some of these economic outcomes that were in favor of the bonding hypothesis do in fact support that, the central tenets of that hypothesis. Also, it gives us an actual channel through which governance is improved, right? So we, Craig was talking about, what exactly matters when we say governance improves? What really are the outcomes? Here we argue one specific outcome is in fact that they shed poorly performing CEOs. And again, provides some evidence that the U.S. legal environment does in fact reach these foreignly listed firms. Now, there's other applications of governance outcomes I think are notable. Joanna Wu has a nice paper that looks at IFRS adoption and CEO turnover and shows that basically after IFRS adoption you see more CEO turnover based on accounting measures. So these accounting measures become more useful and actually allow them to identify poorly performing CEOs. Craig and I have tried to span all possible list of co-authors in the cross-listing literature, and we have a paper that's forthcoming that looks at why firms choose not to cross-list. And we show that basically the firms that stay away from U.S. listings are those with the biggest governance problems. So those with big proxies for private benefits, those are the ones that choose not to list in the U.S. Okay, so again, something that they're choosing not to do, an outcome, so to speak, of their listing decision. Okay. And the second question we said, that's getting a lot of attention now in the popular press and by academics is, does the cost of U.S. securities regulation, really one of the defining features of the U.S. market, right, is perhaps that their costs got to this point where they're exceeding the benefits. And this really has gotten, even the most play perhaps when you look at the reach of foreign firms in interacting with the U.S. markets. And there's been a lot of research by a lot of people in this room that have sort of tried to analyze, what is the effect perhaps of SOX on the U.S. Attractiveness of foreign firms, okay? And that's really has, I think, in a lot of ways spurred the debate. This capital markets committee is suggesting that we're seeing these listings in London now that are driving away U.S. businesses, and now we're perhaps over-regulated, okay? And to kind of get an idea of looking at that, rather than sort of analyzing these voluntary listing or delisting decisions by firms, we try to take a different approach in a new paper I have that tries to look at a new regulatory change and examine sort of, can we get an idea of the costs and benefits of sort of U.S. securities regulation. And the debate has gotten so, I think, heated that the SEC has capitulated recently and actually made it easy for firms to deregister from the U.S. markets. So in this paper, we take advantage of a recent rule, SEC Rule 12H-6, that basically now allows foreign firms to deregister more easily from the U.S. capital markets. Now, prior to this rule, delisting from an exchange is very easy. So you're a foreign firm, you come to the U.S., you don't like it, I'm going to deregister from the New York Stock Exchange, right? So I can stop filing statements, right? The answer is no, right? So even if you're no longer traded in the U.S., as long as you have at least 300 U.S. shareholders or 500 U.S. shareholders with less than $10 million in assets, you still are a SEC reporting and filing company. And so this was basically known as, the U.S. was the Roach Motel of the world, right? Because companies could check in and they couldn't check out. Or, Hotel California, right? The old Eagles song, you can check out anytime you like, but you can never leave. Or even, the SEC commissioner referred to it as the Venus flytrap, okay? So this really got a lot of attention, that they were saying this is another reason why the U.S. market is uncompetitive, because foreign firms are staying away because they know the costs exceed the benefits, and so we need to make it easier. And so in March, the SEC basically, for foreign issuers, relaxed that assumption and now allows them to deregister without having these onerous, what they call noose count provisions, where you have to count each shareholder of record, and you can't even, once you find that there's less than 300, you can't say, okay, I'm done. You can only apply for a 1-year suspension, and every year you have to show the SEC that, my grandmother in Iowa didn't buy a share and bring you over the 301st share. Okay, so when this was announced, the SEC commissioner basically stated, there's been a lot of talk by groups lately about the competitiveness of U.S. capital markets. One consistent theme is that, the discussions, the U.S. needs to pay heed to the strength and growth of foreign markets, okay? And he argued for this sort of decrease in the regulation of U.S. markets. And if we look at sort of the history of disclosure regulation research in the U.S., there's just not a lot of it because there haven't been a lot of major disclosure regulations, right? We have obviously the 33 and 34 Act, the 64 Securities Act, and Bushy and Lutz's examination of the 99 eligibility rule, but all of these are for mandated disclosure increases, okay? And so in this paper, what we look at is what is the market reaction to foreign firms when now they have the ability to opt out of the stringent U.S. investor protections. So perhaps if the costs do indeed exceed the benefits, now that they can get out of those costs much more easily, we should see positive stock price reaction perhaps, right? What do we find? In fact, the stock price reaction is negative, okay? And if you do the economic significance here, it's around 1%, okay? And what does it happen for? It happens for the firms located in the low disclosure, low investor protection countries. So in fact, we argue that this is evidence that suggests that, in fact, investors value the sort of regulation that's in the U.S. market. I'm sure it's not to say that they don't have costs, but it sure doesn't seem to be evidence that suggests that the costs outweigh the benefits. Okay? And so, I'll end on this slide. The past is future. So what do we find? In the CEO turnover paper, right, we find that there's a big impact for the sensitivity performance to turnover for listings in the U.S. We don't find that for London. You look at Craig's results. Premium for U.S., none for London, right? You look at our results here from the 12H-6 rule, it seems to be a value for the US, okay? But what do we see? Just like we saw, 13 years ago, there's a huge increase in London listings. And I pose that as somewhat of a, at least puzzle to academics, because we don't have a lot of economic sort of outcomes or economic evidence that these listings have big value. So, this is a sort of very interesting sort of, I think, avenue to look at. And I would argue that perhaps a better way to get at these questions now is looking at more of these outcomes-based research in terms of governance, as well as exploiting perhaps sort of these, more unique experiments to get at a cleaner test of what are, inherently difficult things to disentangle.